BlackRock enters crisis mode. Private credit funds face redemption limits. BlackRock has limited withdrawals from one of its private credit funds to 5% per quarter despite investor requests reaching about 10%. This restriction follows a sharp decline in the fund's share price, dropping significantly after the announcement. Assets previously valued at full price were recently downgraded to zero, triggering the limits. The move affects one of many diversified private credit funds managed by BlackRock. Private credit funds from major firms including BlackRock, Blackstone, Blue Owl, Apollo, and KKR face similar challenges. Share prices have declined across the sector, with some funds down 11% or more and others experiencing 25% drops. Redemption pressures have increased as credit conditions worsen. One firm handled a record 7.9% redemption request on an $82 billion fund by paying out fully, while others imposed stricter limits. The business model relies on investor capital to purchase high-yield assets, often riskier loans yielding around 12% compared to 4% for 10-year treasuries. Managers collect fees based on assets under management regardless of performance. Valuations may remain inflated to sustain inflows and fees, with write-downs delayed until unavoidable. Recent cases show loans marked at full value reduced to zero in a single quarter. Systemic risks arise from interconnected lending. Banks provide low-cost funding to private credit firms, which then extend high-interest loans to riskier borrowers. Spreads generate profits for managers with limited downside exposure due to fee structures. Deteriorating labor markets and rising defaults create a potential doom loop of tighter credit, reduced liquidity, higher unemployment, and deeper economic contraction. The credit cycle appears early in a downturn phase. This development signals broader instability in private credit markets, with potential recessionary impacts. Investors face liquidity constraints and valuation risks in these funds. Protection strategies include positioning for economic stress, such as long positions in short-term treasury futures, though individual actions vary.